It's 11:47 p.m. You're in bed. Lights off. Phone glowing. Zillow is open. You make $85,000 a year. You've done everything right. Degree, job, savings, credit score above 720. And yet, every house that doesn't look haunted starts at $420,000. The photos look fine. The price does not. Then the email comes in. You're approved. Your agent says, this is normal. Your parents say, when are you going to stop renting? So what's the problem? Here's the problem. Approval is not affordability, and nobody in that transaction gets paid to tell you that. Welcome to the last receipt. Today, we're calculating what you can actually afford without turning your life into a 10-year stress marathon. Median household income in the U.S., $84,000. Median home price, $415,000. That's nearly 5x income. In the 1980s, homes were closer to 3x income. That difference changes everything. You're not bad with money. You're shopping in a market priced for a different economic reality. There are two numbers you need to understand. The bank's number, 43% debt-to-income ratio. Translation, if 43% of your gross income goes to debt, they'll approve you. But gross income isn't what you live on. That's before taxes, retirement contributions, health insurance. The bank's job is simple. Make sure you don't default. Your job, make sure you don't hate your life. Those are not the same goal. Let's run the math. House price, $425,000. 10% down, $42,500. Loan, $382,500. Interest rate, 6%. Principal plus interest, $2,295 per month. Sounds manageable. Now let's add reality. Property taxes, $425 a month. Home insurance, $275 a month. PMI, $260 a month. Maintenance reserve, $350 a month. Total real cost, $3,605 per month. Not $2,295, $3,605. Imagine this. You close, keys in hand, photos posted. Family congratulates you. Month 1 feels fine. Month 3, you hesitate before ordering takeout. Month 6, you skip a weekend trip. Property tax bill just hit. Month 9, the water heater dies. $2,100. Suddenly, the house doesn't feel exciting, it feels heavy. That's what 43% feels like. To keep housing at 28% of take-home pay, you'd need to earn roughly $150,000 to $155,000 per year. The bank might approve you at $100K, but comfort requires much more. That gap? That's where people become house poor. Let me tell you about Jason and Emily. Combined income, $92,000. They bought at the top of what they were approved for. Everyone said, "You'll grow into it." They didn't grow into it. They grew stressed. Here's their math. Take-home pay, roughly $5,300 per month. Housing, $3,600. That leaves $1,700. Now subtract groceries, $700, utilities, $350, car payment, $600, gas plus insurance, $400, health insurance, $400. They're negative every month, before saving, before emergencies, before life. One HVAC failure? Credit card. One medical bill? Panic. That's not ownership. That's pressure. Your parents bought in a different system. 1985, homes were 3 times income. Today, closer to 5 times. They paid 12% interest, yes, but on a $70,000 house, not a $500,000 one. You can refinance a rate. You cannot refinance a massive purchase price. The principal is the anchor, and it stays. San Jose, tiny condo. Dallas, nice suburban house. Cleveland, luxury. Same country, completely different game. You're not failing. You might just be in the wrong zip code. Right now, in many major US cities, buying costs 30 to 40% more than renting. In some places, nearly double. A rent payment is the maximum you pay. A mortgage is the minimum. If you invest the difference wisely, renting can actually accelerate wealth. Home ownership is not automatically wealth building. It's math, not emotion. Most homeowners have rates under 5%. They're locked in. They're not selling. Low supply keeps prices elevated. Waiting for 2008 again? That's not a strategy. That's a hope. You have 4 real moves. 1. Buy below your ego. Smaller house, longer commute, boring decision. 2. Move. Geographic arbitrage is real. 3. House hack. Duplex, rent rooms, offset costs. 4. Wait. Increase income, build investments, grow optionality. There is no trophy for stretching yourself thin. Tonight at 11:47 p.m., when Zillow is open again, ask yourself, are you shopping for a house or are you shopping for validation? Because being approved does not mean you're safe, and buying too much house is one of the fastest ways to trap your future income. You are not bad at money. You are operating in a housing market that expects top 15% income for average homes. Understanding that difference might save you a decade of stress. Every month leaves a receipt. Make sure yours is written by you, not by a bank's algorithm. See you in the next one. Thank you for watching. Please like and subscribe.